According to Peter Lynch, if you spend 13 minutes thinking about economic and market forecasts, you've wasted 10 minutes, as it's just not worth thinking about. This successful investor and a legend in the mutual fund industry is known for managing Fidelity Magellan. After he became well known for growing its assets from less than $100 million to $13 billion, Forbes nicknamed him America's Money Manager. He soon established the world's best-selling stock fund for over a decade during the 1980s bull market. Although much has changed since then, Lynch's boyish fascination with stocks has not. Since 1990, he's mentored virtually every equity analyst at Fidelity while writing numerous best-selling titles on investing, like One Up on Wall Street and Beating the Street. These classics are countless pearls of wisdom, which is why we've decided to list our pick of his 10 investing tips. Feel free to tell us tricks you've learned from this successful investor in the comments.
Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement.
Invest in what you know. Peter Lynch has stressed many times that the single most important thing for everyone to know about the stock market is to know what they own. He stated on numerous occasions how amazed he was how many people who owned stocks yet couldn't tell you why they own them. According to him, you shouldn't own a stock if you can't explain why you own it to a 10-year-old in a couple of minutes or less. But this quote is frequently misunderstood. Lynch is not encouraging investors to buy stock in a company just because it makes their favorite product or service. Although that can be an invaluable starting point, Lynch also suggests diving into the business's financials, competitive position, as well as growth prospects before investing in its stock. When he tells investors to buy what they know, he suggests to stay within their circle of competence and investing in industries they understand well. Besides, the practice of investing with their own understanding will solve half of their problems, since it enables them to spot red flags in a company sooner. There are many examples of these kinds of investments in recent years, since the frenzy in the pharma, chemical, and IT sectors have guided investors to buy such companies without having the slightest idea about the businesses behind them. Do your homework. Although first-hand observations and anecdotal evidence are a great start, all great ideas need to be followed up with smart research. According to Lynch, if you don't study any companies, you have the same success buying stocks as you do in a poker game if you bet without looking at your cards. Since you should always invest in what you know, you need to take the time to learn about what you don't. Rigorous research was a cornerstone of Lynch's success. When trying to follow up on the original spark of a great idea, Lynch lists specific fundamental values that he expects to be met for any stock worth buying. These include the percentage of sales, PRG ratio, and favoring companies with strong cash positions and below-average debt-to-equity ratios. You should make sure that your company of interest comprises a high enough percentage of sales to be meaningful and look at the PEG ratio of valuation to earnings growth rate to see how much expectation is built into the stock. Study history. Lynch strongly believes that history teaches you the market goes down. And the simple math shows that it goes down a lot, so you need to know that stock prices move and be prepared for them to go down. Investors don't necessarily need the why behind it, they just need to know that it happens often and it's normal. If they're not ready for that, they shouldn't own stocks. For example, during 93 years, the market has had 50 declines of 10% or more, which is called a correction, meaning a lot of money is rapidly lost. Of those 50 declines, 15 have been at least 25%, which is recognized as a bear market. So, the market has a 25% decline every 6 years, and that's what investors need to know and accept before investing. The most important organ is the stomach, not the brain. The amount of bad news you could hear on your way to work is almost infinite, and you should ask yourself if you can take that. That's why Lynch believes that the most critical organ in the stock market is the stomach and not the brain. According to him, the solution to obtaining money in stocks is to avoid being scared out of them, and that an investor doesn't need more than 4th grade math to succeed. If you really believe that common stocks are the place to be 10, 20, or 30 years from now, you should have some money in equity funds. But another question is what your tolerance for pain is. No one knows when declines are going to happen. It might be tomorrow or it might be a year from now. You need to have the stomach for this, as most people do pretty well because they just hang in there. If we look to the past, many investors have had to grit their teeth through plenty of pullbacks before they got to enjoy outsized returns from some of the most successful companies. The typical big winner generally takes 3 to 10 years to play out. You have to have patience. People who buy stocks expecting to make a quick buck tend to fail. If you want to succeed at investing, you should take a long-term approach and load yourself with a lot of patience. While you probably won't see the gains you want in your investment account in a year or two, your patience is likely to pay off over time in the form of substantial gains if you gather quality stocks and leave your portfolio intact. Investing requires one to make knowledgeable decisions based on things that have yet to happen. Past data can indicate things to come, but it's never guaranteed. In his book One Up on Wall Street, Lynch stated that if he'd bother to ask himself how a stock could possibly go higher, he would never have bought Subaru after it already had gone up 20-fold. It's essential to invest based on future potential instead of past performance. Long-term investing is crucial to greater success, and genuinely life-changing wealth is made over years and decades. Focus on the companies, not on the stocks. Stocks represent partial ownership of a real business, which is why the business's fundamental drivers like revenue, profits, and cash flows will ultimately determine its stock value. Lynch doesn't advise investors to buy stock in their favorite store solely because they like shopping in the store. They also shouldn't buy stock in a manufacturer because it makes their favorite product or a restaurant because they like the food. These are fine reasons to get interested in a company and put it on the research list, but it's not enough of a reason to own the stock. You still need to do the homework on the company's earnings prospects, financial condition, competitive position, and plans for expansion before you invest in it. Macro predictions are a waste of time. Lynch believes that there's no point in attempting to predict macro indicators, as no one can predict interest rates, economic growth, or the stock market itself. He states that if anyone correctly predicts interest rates 3 times in a row, they would be a billionaire. Since there are so few billionaires on the planet, there can't be that many people who can predict interest rates. It is considerably more productive for an investor to direct their time and energy on systems that are potentially understandable in a way that could expose a mispriced asset. Investors should instead focus on individual companies. Seeking to understand something as complex as an economy that exceeds the market is not a clever use of time and is unlikely to happen. You don't have to kiss all the girls. One of the things Lynch stated in his book is that kissing all the pretty girls was not a realistic goal while he was in high school and college. This principle also applies to investment, since an investor cannot buy all the outperforming stocks or top-performing funds. Lynch acknowledges that there will always be some people who are smarter, better looking, and wealthier than he is. However, that has little to do with whether he can continue to outperform if he sticks to his systematic, disciplined process. The behavioral intelligence to preserve independence is more important than being a genius. If I could avoid a single stock, it would be the hottest stock in the hottest industry. In One Up Wall Street, Lynch defined hot stocks in hot industries as those that get a lot of early publicity. Although they could see huge growth initially, they will burn out quickly as investors realize that they do not have the profits, earnings, or growth potential to support the buzz. He suggests avoiding such stocks and instead investing in companies that one understands. Don't be brainwashed by the media. The media made many small investors believe that they don't stand a chance against institutions, making them do inexplicable things like buying options or stocks for a week. Lynch believes that small investors have been convinced by the media that they have no chance, and that the big institutions have all the edges. This can be seen in the fact that numerous business channels give buy and sell calls during the day, while naive investors act on them without doing any research. Be sure to comment down below and let us know if we've missed something. Hit that subscribe button and turn on the bell to never miss an upload. Thank you very much for watching.